You got Deutsche Bank, one of the largest banks in the world, flaming out, and Italian banks with 18% non-performing loans and rising, almost as bad as Greece years ago. So this is going to come to a head, and the markets are just going to keep going up until something hits them that they can't deal with, and central banks can't print their money way out of their money. And I think it is coming soon. I would say the market's going to start heading down within the next 3 months. I will go out on a limb on that one.
Okay, so in the next 3 months, it starts to unravel. That's your point. Yes. And this is October, whatever it is, at 10 past 10 Eastern time on Tuesday morning.
Some cautionary words there from economist, author, and famed market forecaster Harry Dent during a recent appearance on the Fox Business Network. In fact, Harry is just one of several guests we have today on this very special edition of The Income Generation. This edition is devoted to an annual year-end tradition among economists and market analysts. That is, forecasting the year ahead. And this is The Income Generation, the show where we share valuable financial information for that critical period in life when you're either in or approaching retirement. And of course, I'm your host, David Scranton. While Harry Dent didn't share his entire 2017 forecast with Fox Business, he did tell host Stuart Varney that he's anticipating a major sustained stock market plunge coming up in the next few months based upon several factors. The main one being that the markets are becoming more and more vulnerable to a lot of increasingly negative economic influences around the world. We've talked about some of those influences right here on the show, and we'll do it again today as we hear not only from Harry Dent, but from 3 more of the most respected market experts in the field today, as well as yours truly. In addition to Harry, we'll hear insights about what 2017 may hold in store from International Economics Authority, Peter Morici, renowned investor and businessman Jim Rogers, and noted options trader and entrepreneur John Najarian. At the end of the show, again, I'll share my own thoughts about 2017. Now, most of these experts with us today have been guests of The Income Generation in the past, and we're happy to have them back for this so important episode. And it is important. Probably one of the most important shows we've ever done, particularly if you're part of the income generation, meaning that you're over the age of 50 and you're either actively saving for retirement or already retired. The reason it's so incredibly important should be obvious based upon the small fraction of Harry Dent's forecast you've already heard. You know, if you've been watching the show over the past 10 months or so, that I believe we are at a pivotal, even critical period for our financial markets and global economy. For 8 years now, our Federal Reserve and other central banks around the world have basically been conducting an epic economic experiment, the outcome of which hasn't yet been determined. But when you look at these details, you realize it's possible that we could see that outcome play itself out very, very soon, and that it could be absolutely disastrous. If you're a regular viewer, you probably know that the epic experiment I'm discussing is the rampant use of quantitative easing and other artificial stimulus measures to try to jumpstart struggling economies. Our own Federal Reserve bears much of the blame for launching this experiment and letting it get so that, as many economists now believe, out of control. Now, granted, yes, the financial crisis of 2008 and 2009 was the absolute worst financial disaster in our country since the Great Depression, and shockwaves from it reverberated throughout the entire global economy. So I'm not going to argue that there wasn't a need for some type of response on the part of our government. In fact, setting policies and taking steps to deal with economic crises is one of the mandates of the Federal Reserve. But the steps undertaken in this case were unprecedented, and I argued from the very beginning that they're also short-sighted and potentially extremely dangerous. But when they didn't work as quickly or as effectively as the Federal Reserve would have liked, rather than scaling back, they ramped up this unprecedented experiment. Ultimately, we went through 3 rounds of quantitative easing, and 4 if you count Operation Twist, all with the same objective: to jumpstart the economy and to get it back on track of what was self-sustained growth, but it still hasn't really happened. Yet, despite the underwhelming results, other central banks in Europe and around the world soon adopted our own bad habits, and the epic experiment went global. So what does all this mean, and what does it have to do with my market forecast for 2017? Well, just about everything. That's because the chickens are possibly finally coming home to roost as far as quantitative easing is concerned, and the timing, I believe, couldn't be worse. After years of money printing, bond buying, and suppressing interest rates, central banks are running out of these artificial options, and in most cases, their economies are still struggling. That goes for our own, as I'll talk about later in the show. The timing couldn't be worse because I believe we're still in the midst of a long-term secular bear market cycle that history indicates is now overdue for another major and sustained stock market plunge. That means a collapse on par with the nearly 50% drop that began in the year 2000 and the nearly 60% drop that began in 2007, or possibly even larger than that. And yes, it's quite possible that the only reason it hasn't happened yet is because of this epic experiment, which is now quickly running out of steam. One side effect of quantitative easing, and one of the reasons the Federal Reserve became so reluctant to abandon it, was that it actually made Wall Street very, very happy. It created cheap money and it forced everyday investors up, as we analysts like to call it, up the risk curve, making them think the stock market was the only game in town with near zero interest rates in many other competing investments. So for the past 3 years or so, as recently as the summer, these influences have begun to push the markets to new record highs. And with the arrival of fall, we've seen things change, I believe dramatically, and the markets have now posted 3 straight months of decline. Question becomes, will that trend continue in 2017? And if so, just how dramatic and how bad could it actually get? And more importantly, what can investors like you do to protect themselves? Well, you're about to find out today. So stick around for this very special, very important episode of The Income Generation.
The closing numbers on the markets today. At one point, the market fell as if down a well, over 700 points.
Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Finally, there is an alternative. Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Plan with confidence, knowledge, and peace of mind. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
So happy to welcome back the man I was fortunate enough to have as my very first guest right here on The Income Generation, Mr. Harry Dent. I knew I wanted Harry back for the show because he's particularly renowned as an economic forecaster. In fact, in 1989, I know we're dating ourselves here, but in 1989, yes, he warned that Japan's collapse was inevitable. In the 1990s, he called the bursting of the dot-com bubble. And as early as 2006, he was sounding warning bells about the collapse of the housing market. Harry is a Harvard-educated economist, author, publisher, and highly sought-after speaker and market analyst. And I'm so happy to have him back here on the show. Harry, welcome.
Nice to be back, David.
You know, you're a man after my own heart. You got the open collar look. You know, I love that. I've sworn off the neckties myself a long time ago. And as good as you look today, I'm sure your market forecasts for next year are going to be even better. So tell us what you see ahead now over the next 12 months or so, 2017.
Well, I think 2017 is probably going to be the worst year for the stock market we've seen since 2008. And what we've really done is just seen central banks keep a bubble going one more time. This is the third stock bubble in a row. We had one peak in 2000, then one peaked higher in 2007, and now in 2015 to 16, different peaks around the world. Most of the world markets peaked back in mid-2015. And this has all been artificial. I mean, this has been companies buying back their own stock and financing with cheap money, mergers and acquisitions. That hasn't been real solid earnings, and consumers keep struggling. And the economy keeps barely growing 2%, and only because of the wealth effect created by this. The problem with all this quantitative easing and free money is simple. It creates bigger bubbles. And bubbles do only one thing in life and all throughout history. They burst. And now we've got a bigger bubble than we had before. Sure. And a lot of real estate markets that higher than they were in 2006 when they peaked and stuff. And so I see the big bubble burst again. And I think even central banks around the world, including now the Bank of Japan, Bank of England, and of course the ECB, they're no longer increasing their quantitative easing, and they're talking about pulling back from it because they're finding with negative interest rates, it actually has more harmful effects than good. We've always said you can't do this forever. You can't get something for nothing. So I think the gravy train's running out, and we're going to see stocks crash 40, 50% or more next year. And then it'll probably be late 2019, early 2020 before we pull out of a bigger downturn. Remember, the pattern is each bubble takes us to new highs, but each crash takes us to lower lows. So I'm seeing the Dow being down at least 70% in the next 3 years.
Harry, it was just about a year ago you told our income generation members that that's the megaphone effect. I remember that distinctly. Yeah. Now the question is, what are your thoughts about the election outcome? You know, does that slightly decrease the chances of, or the magnitude of a drop in 2017? Does it make it worse? Or is what you're talking about here bigger than politics and really have minimal effect at the end of the day?
Well, you know, politics does have minimal effects. That's why our forecasting methods work so well. We look at people and the predictable things people do as they age, spending and innovation and saving and all types of things, and buying everything from potato chips to cars to houses and stuff. And we don't look at the government as much. I mean, consumers and businesses are 80%. We also look at innovation cycles in business and technology, and we look at geopolitical cycles that affect everybody. Governments don't drive these things. Governments react to the economy and the trends we set. They don't drive the trends, except like in third world countries. Now, Trump coming in is a little bit of a wild card. I mean, one reason interest rates are rising, even though we warned that was going to happen anyway, and the markets are getting one final fling out of this, thinking, switching from saying Trump's going to wreck the whole global economy to now he's Jesus walking on water or something, and he's going to create growth and all this sort of stuff. And that this thing is too big. They have stretched this bubble now 8 years beyond anything anybody would imagine. $13 trillion worth of free money created, and pushing down bonds so far that the ECB in Japan can't even find any bonds to buy anymore. The U.S. had to taper in 2014 for similar reasons. We were pushing up our dollar. We were attracting too much capital, creating worse bubbles. So again, bubbles have their own limits, and they dive their own extremes. And so this bubble is going to burst whether Clinton or Trump wins. Trump just gets a little bit of a honeymoon from the markets here. And fortunately for him, he's not going to be blamed if the economy goes down hard, as I think it will. Hillary would have been blamed. I think in a few years from now, Hillary's going to thank her lucky stars that she lost by a hair.
A little crazy, but so in the last minute or so we have left, just tell our viewers, because I know this is the burning question in their minds, how big can this next drop be? What are you seeing?
Okay, first of all, when you get major stock bubbles, the typical crash is 80. We've seen as high as 89% on the Dow in 1932. The Nikkei's already been down 80% at worst, and it'll probably be down that again from its top. So that's very typical. I think you're going to see 70% on this megaphone pattern by late 2019, early 2020. And then ultimately, there's a kind of another couple of difficult years before demographic trends turn back up. We could see probably down 80%. But that's what people should expect. People think a correction's like, oh, 20%, 30%, even 50. No, not when bubbles burst. It's almost always at least 80%.
I always talk about the Great Depression, the 89%. And I'll ask people, I'll say, the fact that it happened once tells you what? And almost every time people say, well, it tells me it could happen again. And that's correct. So, Harry, we're out of time. Time flies when you're having fun. I really appreciate you being back. And thanks for your expert insight as usual here on The Income Generation. All right, stay with us. We'll be right back with a lot more. If you're not using someone who's well-trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Joining me again today with his insights on the year ahead is Peter Morici, professor at Robert H. Smith School of Business and a highly respected expert on economic policy and international economics. He's the author of a whopping 18 books and monographs, and his work has appeared in pretty much all of the leading public policy and business journals, including the Harvard Business Review. He lectures widely and shares his experience and expertise frequently on Newsmax, CNN, CNBC, and other top networks. And we're glad to have him back here on The Income Generation for this incredibly important show. Peter, welcome back.
Oh, nice to be with you.
Now, you know, in our previous show together, as you remember, I wasted a lot of time today, or back then in that show, asking you about how you learn to tie a bow tie. So this show is too important for that. I promise I'm not going to waste the time. Our Income Generation members are chomping at the bit to hear your thoughts about the stock market in 2017. So what do you think? Up in 2017, down in 2017?
Well, I'm fairly optimistic. The first half of last year was very poor. I'm expecting the first half of 2017 will perform better. Overall, I think that the economy will continue to grow as we did the second half of this year, and that we will see recovery in the oil and gas sector, and we'll see the American financial sector consolidated circumstances a little bit better. And in light of what's going on in Europe, it will profit. So overall, I think that the prospects for the U.S. economy and the stock market are fairly good.
Okay. How do you see the Federal Reserve being able to unwind itself from the effects of quantitative easing? They're trying to raise short-term interest rates and having a tough time so far pulling the trigger past the one small raise they made last December 2015. And not to mention the fact that although we've stopped additional quantitative easing, we haven't really started to take some of those bonds that we bought that are in the Federal Reserve and actually started to sell them back to the public again. So what are your thoughts on the effects that might have?
Well, I don't think the Fed needs to sell the bonds back. I think it can just continue to hold on to them without any consequence. My feeling is in terms of raising short rates, though, we have had prosperous economies with the federal funds rate at 3%. So I don't see why we can't go to 0.5%, 0.75% without too much in the way of consequences, as long as we do it quite slowly so credit markets can adjust to a changed environment. My feeling is that interest rates are so low in Europe, negative in some circumstances, that they're actually damaging. They're damaging to banks and so forth. Very low interest rates are damaging to elderly people who rely on certificates of deposit. You know, you can have too much vitamin C, so to speak, and get a sunburn. Too much vitamin D and get a sunburn. Well, I think the same thing with ultra low interest rates. I don't think this has been particularly good for the economy. So I'm not seeing much disadvantage towards gradually raising them again. My feeling is once we get up around 2%, then we've got something to worry about. But that's a couple of years away with this Fed.
But also, we need to have long-term interest rates be able to creep upward also to even get anywhere near 2% on the short-term side. What do you think is going to change to get long-term rates to start to come up, which will allow the Fed to raise short-term rates?
I think we're already seeing the changes that are necessary for that. Namely, we're starting to get some inflation again. The core rate is, around 1.7% or so, and I see that easing up to about 2%. I think the real challenge for the Fed is going to be keeping inflation inside of its target of 2% as opposed to accomplishing its target of 2%. With a 2% rate of interest, credit markets are simply going to demand more from people who borrow money. And so having 3.5% long rates, it's not going to happen in 2017, but are we going to move in that direction? Well, I think we are. I think we're going to be above 2% by the end of 2017, and I think that we're going to continue to move upward. And I don't think it's necessarily a bad thing. It's important for capital to be adequately priced. We've seen, for example, with construction spending and spending with regard to new plant and equipment, having zero interest rates doesn't help. Other things are more important than interest rates. It's just one of many, many factors going into investment decisions. I mean real investments, factories and things of that nature.
Well, and our long-term rates will continue to creep upward as our economy strengthens. It's all supply and demand of money at that point.
Well, I think we have to have more robust growth than we've had. 2016 was simply not a good year for economic growth. The average is going to come in around 1.7. My feeling is that 2017 will be better for growth, and that in itself will give us better corporate earnings. One of the things I'm looking forward to seeing a change is that the new administration will be suing banks less. And trying to extract very large settlements out of them. That, along with higher interest rates, will make banks more profitable. That's an important sector. My feeling is the energy sector will not be a great place of robust profits in the way that $100 a barrel oil was. However, oil at $50 a barrel is going to be better than oil at $40 for their profitability.
Sure.
And, one of the telltale signs of that is that drilling has been up a lot since May.
Okay, so bottom line is you think with oil, with commodities coming up, that's also going to help productivity. We're going to see, as a result, we'll see some positive upward pressure on GDP, a little bit of upward pressure on inflation, at the same time bringing more corporate revenues, and we'll ease ourselves out of this, even though interest rates, short-term interest rates may only go up a quarter or half point. I appreciate your input today.
That's pretty much it, yeah.
Yeah. Well, Peter, thank you very much, as usual. Unfortunately, we're out of time, but your contribution to this 2017 forecast show is obviously very important as a repeat contributor to the income generation. So, Peter, thank you. For our viewers, stay with us. We'll be right back with more. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. Now it's time to welcome back author, businessman, and acclaimed investor, Jim Rogers. Jim is co-founder of the Quantum Fund and founder of Rogers International Commodities Index. He's highly respected for investing expertise and for his insights into the global financial markets and world economies. And that global perspective is especially important today. So we're thrilled to have Jim back on the show. Jim, I understand you went through some quasi-heroic efforts to get here today for our Income Generation viewers. You traveled from China to Singapore and just arrived. So our Income Generation members appreciate your efforts and anxiously look forward to your insight about the markets in 2017.
Well, David, I'm delighted to be here, and I like your introduction. But remember, I make plenty of mistakes. My goodness. So be careful if you listen to me. Who knows if I've got it right or wrong. I'm extremely worried about the world economy and markets next year and the next couple of years. Most stocks in the U.S. have been going down for 2 years. The averages are up because of a few big companies, but stocks in most of the world have been going down, David, and that usually means we're on the way to a decline which everybody will know about.
What do you think is more likely to happen? The U.S. markets start to slide and then it drags international markets downward? Or do you think international markets are more likely to start to slide and drag the U.S. markets downward? If you had to guess, which camp would you be in?
It usually works, David, that a marginal sector, a marginal country declines. In 2007, Iceland went bankrupt. Most people said, what's Iceland? Didn't know they had a market. Then that led to Ireland. Then that led to Bear Stearns. Then that led to Lehman Brothers. And everybody knew there was something wrong. So normally it will probably not start in the U.S. It might, but it's already started elsewhere. Japan is already in recession, the government says. Parts of Europe are in recession. So it's already happening. It will probably get to the U.S. last because of the big stocks that keep going up.
Now, we spoke last time, you're still pretty optimistic on China, for example. What are your thoughts as we sit here today on China's markets through 2017?
Well, I own Chinese shares. I hope I own the ones that are going to come through okay. I'm short the United States. China is certainly going to have setbacks. I mean, all of their customers are having problems and will have problems. So obviously, if you deal with people who have problems, you've got problems. Plus, David, China now has debt. China's not had debt for decades for historical reasons. But after 2008, they started building up debt too. So if you're involved with Chinese companies that trade with the West and have debt, you're going to see some bankruptcies.
Of course, of course. Okay, very good insight. You know, it's interesting. Last time you were on, you know, as any good interviewer does, he likes to needle and jab a little bit. So I was teasing you about China. I was talking about those famous empty cities that have been built that really have no one in buildings, et cetera. And I was trying to get you to say that, gee, there might be a bubble in China. And you retorted by saying, heck, Dave, you've got a bigger bubble right there in the United States that the Federal Reserve has created. And I kind of laughed and said, okay, you've got me. I can't argue with that. What role do you think the Federal Reserve's previous actions are going to eventually play in this market drop that it seems like you and I seem to be on the same page in forward-looking for 2017?
Oh, there certainly are some property bubbles in China, but all the bubbles in the world, David, now are caused by all this artificial money printing.
That's right.
From the Federal Reserve in the U.S. They have taught the Japanese to do it, the Europeans, the British. Everybody's printing money. So we have a gigantic sea of liquidity floating around the world. Yes, it's having effects in China. It's having effects everywhere. If you're looking for a single culprit for what's about to happen to all of us, it's Washington, D.C., including the Federal Reserve.
Yeah. And it's all the central banks, if you think about it. Like you said, we're kind of like the uncle that taught the nephew how to pick his nose. And it's all fun and games until you're the parent sitting in church and your son is picking his nose. And you know, we've taught other countries to kind of sort of do that, if you think about it. They're picking up our bad habits, aren't they?
Oh, yes, yes, yes. Everybody's doing it. The amount of debt that has gone up worldwide is staggering in the last 8 years. You know, everybody talks about austerity. Nobody has practiced austerity. Every country in the world has increased its debt in the last 8 years, despite all the talk.
And what role in this do you think corporate earnings will play? The fact that corporate earnings have been highly manufactured over the last 8 or 9 years or so, and all these share buybacks, stock buybacks from major U.S. companies. How big of a role do you think that'll play in 2017 in causing?
Well, David, that's the reason the U.S. stock market is up. It's artificial. The S&P earnings have been going down for 6 quarters. Things have been held up by money printing, stock buybacks, artificial accounting. The world's facing some serious problems, and they're already starting. Be worried, David. Be worried.
Well, I am worried. All of our income generation viewers know we always talk about this. I'm personally surprised we haven't seen a drop after 2013, 2014. And it seems like you're right. All these economic steroids, as I like to call them, have kept things artificially inflated. You know, you mentioned Japan earlier. And Japan's been having severe deflationary pressures and been in basically a zero interest rate environment now for close to 25 years. Do you think we're following suit with what Japan's been through?
Didn't work in Japan, David. It's not going to work here. Whether we follow them or not, all the policies in the U.S. are not working, as you know. So it doesn't matter whether we're following them or not. It's not working.
So in closing, Jim, what would you say to our investors for 2017? The last 30 seconds we have, if you were to give them any words of wisdom, what would those be?
Watch Newsmax, get prepared, then you will get worried, and then you will get prepared for what's coming. But come informed, because it's going to be a big, big mess, David. Be worried, be prepared.
Wow, those are some pretty strong words, and I can't say that I argue with any of those. Thank you so much for joining us. I really appreciate you being here today, Jim. Thanks again for the heroic efforts.
Thank you, David.
And for our viewers, stay with us. We'll be right back with more from our next expert about 2017 and what it may have in store for you as an investor. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. My next guest, John Nigerian, is a successful options trader, market analyst, and co-founder of Nigerian Advisors, along with his brother Pete. John started his financial career at the Chicago Board Options Exchange back in 1981 after a brief career in professional football with the Chicago Bears. Known to many by his trading acronym of Dr. J, John is a regular contributor to CNBC's Fast Money and is always in high demand as a provider of market intelligence, commentary, and trading strategies. We are extremely glad to have him back on our show. So John, welcome.
Great to be back with you. Thank you very much.
First and foremost, how about those Cubs, huh, John?
It was phenomenal. 108 years in the making, as they say, but that was great. It was great to see all the enthusiasm and those W flags flying. It was a fantastic time to be a Cubs fan.
I was on a long business trip during that, and I was ecstatic to see it just being from hotel to hotel. So that's wonderful. But yeah, obviously we're not here today to talk about baseball or even football for that matter. We're here to talk about the markets in 2017, the economy in 2017. So as we sit here today post-election, what are your thoughts about next year?
Well, I think there were going to be 4 different sectors that were going to be impacted by these 2 candidates, one of which, of course, Mr. Trump won out. They were defense spending, materials, health care, and of course, anything that involved with taxes and so forth were going to be changed. Now, obviously, under Ms. Clinton, we would have seen health care go the opposite direction that we're seeing it go under Mr. Trump, because he's talking about rolling back Obamacare or the Affordable Care Act. So as far as the things I'd focus on into 2017, number one, healthcare stocks, whether it's insurance or healthcare. Number two, banks, because he's also likely to roll back a lot of the restrictions on bank lending, as well as potentially not enacting some of the parts of Dodd-Frank that I think were potentially job crippling. So those two sectors, I'd say healthcare and banks, are taking the opposite move under Mr. Trump that they would have taken under Ms. Clinton. Defense stocks and materials, they would have done well under either president.
So I guess what does that mean for the market overall in your thought process for 2017? You know, we've had a great run here all since, as you know, March 9th of 2009. So are those four sectors alone enough to keep the market held up or to grow or pull back? What are your thoughts?
I think that's more than enough to keep the market going up. Will there be some pullbacks? Absolutely. I mean, for instance, a lot of folks look at the rally that we've had since the election and they think, oh, it's too far too fast. It's been a rotation is what it's been, because you've only seen about a 1.5%, 2% rise out of the S&P from election night all the way through today. But of course, we had that big V-shaped drop election eve in the evening of that night into the next morning. But where the actual close was, let's call it 2140. We were around 2174 yesterday. So that amount of movement to the upside is not spectacular, but the moves in those four sectors that we just discussed, those are huge capitalization stocks, you know, whether it's the banking stocks, healthcare stocks, material stocks, defense stocks. These are four huge areas of the economy. They employ a lot of people, so that's very good. They also are big percentages of the S&P 500. So I'd be pretty confident saying that we'll get some pullback, certainly, but I think these are enough to lift the markets well into 2017, perhaps even into the midterms in 2018.
The most interesting thing for me as a fixed income specialist is really what happened to interest rates. You know, in a week, we saw 0.5% get tacked on to the 10-year Treasury, all because of this projection, this hope that the GDP can now get out of the schneid, if you will, stuck at 1% to a higher number. Do you think the chances of that GDP increase has just gone up?
I do. I think the GDP increase probably between 0.5% and another full percentage point from where it would have been, as you say, prior to this election. So people are anticipating some inflation. They might not get as much as they're counting on right now. In fact, some of the other things that might play into this are some of the tax cuts that are likely to get right through a Republican Congress with Mr. Trump as president. So I think you're going to see a lot more money spent. That's part of that inflation that people worry about, in particular people in your space where they're talking about fixed income, because bonds, that's one of the things people trade bonds for, is to protect themselves in many cases from inflation. When they're seeing that inflation, they tend to shun those bonds because why wouldn't you be in something that's inflating or growing up, getting bigger, rather than something that's shrinking? The bonds tend to move in that opposite direction, as you just cited very accurately.
John, real quick, in the 30 seconds or so we have left, I'd like to ask you, you know, we still have, Hillary Clinton still won the popular vote, so there's still slightly over 50% of Americans that threaten to move to Canada, and whereas they may not move to Canada, emotionally they may not feel so comfortable any longer with the outcome of the presidency. And despite all the reasons that the economy should do better under a Trump presidency, the question becomes, what if they emotionally get nervous, start pulling money out of the market? Is that a concern to you at all? Have you thought about that?
That would be a concern if people start pulling money out of the market. I haven't seen it yet. I've seen sort of the opposite, just like you have.
That's
a lot of money coming out of fixed income into stocks. I think that'll continue. I think greed is a greater motivator than people trying to walk and you know, exercise their rights, of course, to protest. But I don't think those protests will result in them pulling cash out of the market. I think they'll basically chase the market like the rest of us.
That's great. I think you're right. Greed is a very good motivator. So, John, one more time, thank you so much for being back with us. Sure. I really appreciate your insights here at year end. Thank you.
My pleasure. Thank you.
And for our viewers, stay with us. We'll be right back with a lot more.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
Now, you've heard a lot of highly educated insights and opinions here today, and I want to thank all my guests for sharing them. And if you're watching, pat yourself on the back, because it means that you know just how important it is to stay educated and up to date with what's going on in the financial markets today. You're practicing diligence and detail orientation, which, as you know, are 2 of my 7 core values for helping protect your money in good times and bad. Now, if you're a regular viewer, or if you've read my book, Return on Principle, you know that the first core principle I advise is overprotection, erring on the side of caution in order to better ensure that you'll have more than enough income to meet your retirement goals. I mention that now because I want you to keep it in mind as I share my own market forecast for 2017. Also, please keep in mind that no one has a crystal ball, and that even the most educated and experienced analysts can only speculate. As we all know, a lot of experienced, educated pundits and journalists made very confident forecasts about this presidential election that just passed, which turned out to be dead wrong. And because they turned out to be wrong, I think it's the age of economic uncertainty to even a larger scale than I've even talked about in the past. In other words, the one thing I'm not forecasting for the year ahead is a flat, stagnant market. In fact, I'm forecasting anything but. I'm personally considering one of 2 extreme possibilities based upon the dichotomy created by Trump's presidency, a dichotomy between logic and emotion. Let's start with the logic. Logically, having an experienced businessman in the Oval Office should be good for the financial markets and good for the economy, and should enable these markets to possibly stave off another major sustained plunge longer than, let's say, a Clinton presidency might have. However, emotionally, many Americans are worried about this particular businessman running the country. If this worry continues, it could lead to a scenario that might actually cause the next major market plunge, the one that I've been discussing and foreseeing now for every bit of the last year or more. In fact, this would be the 3rd such plunge of our current long-term secular bear market cycle, which, according to the lessons of market history, is already way, way overdue. So let's look at the logical scenario first. Now, whether you love or hate Donald Trump, there's no denying that he's a natural politician. And in this campaign, he clearly out-politicked his opponents. He knew just what he had to say to get elected, and he said it. But I believe that, like any politician, he's a chameleon, and his colors are likely to change when he's in the Oval Office. We have already seen signs of that in his first 3 weeks as president-elect, signs that he probably won't be taking some of the most radical economic measures that he discussed during his candidacy that made investors nervous. Therefore, to me, it seems logical to conclude that Trump has the potential to keep the next market crash at bay longer, simply because his true colors are those of a businessman. I've always said that economically the country should be run like a business. And if he does just that, it could very well end up being a good thing for the markets and the economic growth. For example, some people were concerned about his protectionist policies during the campaign. But economically, when you look through those those policies weren't as bad as many thought. Basically, they amount to making sure that we put our own country's products and businesses ahead of foreign companies and imports. Now, that would be a good thing economically, and so would his vows to overhaul Obamacare, the Dodd-Frank Act, as well as the corporate tax structure. Here's another important consideration. In this age of quantitative easing, with the markets so incredibly influenced by artificial factors, it might just be good to have a businessman in charge who knows how to create economic value somewhat artificially. For example, as many know, Trump's real estate empire consists largely of properties that he doesn't really own, but that earn him tens of millions of dollars because they bear his name. He's created such a high-end brand association with the name Trump that it alone could increase the economic value of our stock market. As I've discussed on other shows, we're already considered by many internationally as the cleanest dirty shirt in the world's economic hamper. And the idea that Trump might just bring his own Midas touch to our stock market could make us appear even cleaner. Now, we also know that Donald Trump isn't afraid of debt. And this raised some eyebrows and some concerns during the campaign about him possibly increasing our national debt significantly. And it could be that our debt will continue to increase at the same rate under Trump as it did under President Obama. However, as a businessman, Trump also understands that if debt is managed properly, it can be turned into growth. I think the odds of that trade-off are better under him than they would have been under Hillary Clinton. Yes, it is possible that we could see our national debt double again in the next 6 years, just as it has in the last 6. But hopefully that means instead of a accompanying GDP rate of only 1%, we could see possibly 3 or maybe even 4%. So while the markets were rocked at first by Trump's election, they rallied more quickly than they did after the Brexit vote. The Dow Jones Industrial Average futures were down 800 points in the middle of the night right after the election, but closed that day, that same day, up 250 points. The yield on our 10-year government bond jumped from 1.82 to 2.07. That's a whole quarter point in one day. By Thursday after the election, the Dow actually closed at a new record high of over 18,800, and within a week, the yield on the 10-year government bond rose to 2.3%. Now, to me, that's a sign that Trump's less radical post-election remarks led investors to conclude that he might actually be a pro-market president, and therefore good for the economy. Now, while all of that may seem logical, we also have to consider the emotional possibilities. As I've explained many times, the financial markets are in a very emotional place. And let's face it, we haven't seen a presidential race this emotional or this divisive in our entire lives. Keep in mind that about half the country is, as of this taping, still vigorously opposed to Donald Trump's presidency. All of these angry people may not end up moving to Canada and protest as they promised, but they could start pulling their money out of the stock market in fear and mistrust of the new president. If that happens, then all those logical theories about Trump's ability to get the economy growing and add value to the stock market could be undercut by the reality of a massive, emotionally led sell-off. This could trigger waves of capitulation in which progressively larger and larger investors feed into the downturn, ultimately creating that third major drop. The drop that I've been discussing now for a full year on the show. Based on market history and the size of our two previous drops, the first from 2000 to 2003, the second from 07 to 09, this next one could be a plunge of between 30 and 70%. So in terms of advice for all investors based upon everything we've discussed today, I would simply say that it's critically important to consider the potential of both scenarios and the impact that that would have on you personally. Now, if you're younger, you might be okay with betting on the first, the logical possibility that a businessman in the White House will continue to hold off the next major market plunge for a good while and possibly even spur more market growth. However, if you're retired, or if you're within 10 years of retirement, in other words, if you're part of the income generation, then you have to really consider whether the potential benefits of the first scenario are worthwhile compared to the potential damage caused by the second. In other words, ask yourself, is it worth gambling to increase your portfolio by 10 or 20% if it means risking a 30 or 70% loss? I tell my clients every day to think of it as if they're going into a casino and they find a gambling table there which says that if you win 10 or $20, and if you lose $30 to $70. The question becomes, would you play that game? Before I go, I want to thank all of our regular and new viewers and give a special thanks to all of our esteemed guests. I also want to encourage you to learn more about today's topic and about how you can get your own copy of my book, Return on Principle. 7 core values to help protect your money in good times and bad. How? Simple, by visiting the website on your screen, returnonprinciple.com. And for other complimentary materials and more information on the show, as always, you can visit theincomegeneration.com. I'm David Scranton, and thank you for watching.